Hello there, this is binaryoptions.net.au, and we are continuing our series regarding how to trade a specific currency pair. Basically, we are making, as you very well know here, a timeless series, so things to consider when trading a specific currency pair. Of course, we started with the euro US dollar, and we moved on with the Great Britain pound US dollar. These are already on the YouTube channel. Feel free to look for them. I would like to move on with the US dollar and Canadian dollar. Again, one of the most interesting currency pairs. It is by far less liquid, so the first thing you need to know about the US dollar Canadian dollar pair is, number one, it is less liquid than euro US dollar, Great Britain pound US dollar, or basically less liquid than other majors. What does it mean? It means that the moves that this currency pair makes are more powerful and more aggressive when they happen, when in comparison with the euro US dollar and Great Britain pound US dollar. So few market participants, if you want, trade this one than the classical major. It is still a major pair in the sense that it has the US dollar in there, US dollar and Canadian dollar. So it is a major pair. So how you trade majors should apply here as well. Now, the US dollar, Canadian dollar, and actually currency pairs, they are representing two economies, and a currency pair moves based on the differences or similarities between those two economies. The spread offered by this pair is bigger than in the euro US dollar and Great Britain pound US dollar case. So it has a bigger spread. Not that this counts when you trade binary options, but anyways, it should worth notice that the spread or the difference between bid and ask is way bigger. Bank of Canada is the central bank, and that's central bank on major economies like Canadian economy have the mandate to keep inflation below or close to 2%. Now, that being the case, so BOC or Bank of Canada is monitoring the situation in the Canadian economy, and of course it is setting the interest rate based on what is happening on the previous months and so on and so forth. Therefore, interest rates are the thing that move this currency pair like any other currency pair. Take a look at this move that you see, the move from the 1.20 all the way up to almost 1.28. This one came after Bank of Canada cut the rates something like 3 weeks ago, cut the rates, and definitely that is not good for currency. Now, Bank of Canada is meeting on a regular basis on a Wednesday, and each meeting is followed by a press conference. You gotta know what the press conference is, and usually the governor there explains the logic behind recent price action, behind recent monetary policy actions, and so on and so forth. What are the most important data to watch for the US dollar, Canadian dollar? Again, it is a pair that is moving based on the economic differences of the two economies it represents, the US economy and the Canadian economy. They are somehow similar in the sense that they even share a border, they are on the same continent and so on, but the Canadian economy is more dependent or heavily dependent on the commodity market, and therefore look especially on the oil market, as Canada is a big producer of oil. Therefore, what is happening with the oil data when it's released, or from a technical point of view, when oil as a commodity breaks specific levels, strongly influence the Canadian data. So if you go on the economic calendar and look what for events that might move the US dollar, Canadian dollar, then on the top of the list should be the oil inventories. When the oil inventories are being announced, this one is moving. Of course, if the oil inventories are lower than expectations, it means that this should be bullish for oil. Bullish for oil means bullish for the Canadian dollar, so the US dollar Canadian dollar should move to the downside. The opposite is true as well. Look also for the OPEC meetings when they are programmed, because supply and demand, the cutting of levels by the OPEC members is extremely important, as market will try to have an idea what the oil price would be. Where the oil price will be, there will be the Canadian dollar as well. Also look at the IV PMI, it is being called in Canada. It is like the regular PMI in Europe, or the ISM, non-manufacturing and manufacturing in US, with one difference. If in Europe, for example, it is being released PMI manufacturing, PMI services, in Canada it's only one PMI, this IV PMI. And it is important because it is compared with the 50 level like any PMI, and it implies that a bullish stance for the economy would be above 50, bearish below 50, and therefore the Bank of Canada will come to cut the interest rates or to raise the interest rates if the economy is going alright or not. How about other economic events to watch out of Canada? Well, after the IV PMI, look for the CPI or the inflation. Inflation in Canada is released on a monthly basis, and of course it is moving expectations on rates and what the central bank is going to do at the next meeting. Look also at the jobs data. And the jobs data in Canada is really important because it is coming on the same day with the non-farm payrolls in the United States. Rarely they are on a different day. This means that on that day you have the non-farm payrolls, the NFP in US. At the very same time you have the data in Canada. So on an NFP day, US dollar Canadian dollar tends to move on chaotic basis, in the sense that depending if, for example, one economy adds more jobs or loses more jobs than the other one, then it will move based on the Canadian dollar and the US dollar as well. This would be pretty much the most important economic events to influence the US dollar Canadian dollar. How about the US? On the US side, the regular stuff applies. So number 8 here, the regular thing applies. The CPI or the inflation in the US. Here look for the core CPI, as the core CPI is the favorite measured move for inflation for the Federal Reserve in the United States. Then look for the NFP or the non-farm payrolls. These NFP or non-farm payrolls are coming on the same day with the jobs data in US dollar in Canada. So that will move rate aggressively. It is released, the non-farm payrolls, it is released on the first Friday of each month, no matter what. It is important as the Federal Reserve in the United States has a dual mandate. So beside inflation, its job is to create jobs. So look for the GDP then in the United States as well as Canada, and ISM manufacturing and non-manufacturing. To be the same as the PMIs in Europe or the IV PMI in Canada, only that these are being calculated by the ISM. ISM means Institute for Supply Management, while the IV, I think it is the name of a new university of something like this in Canada. I don't want to say that as I'm not sure. Then of course look in the US for the durable goods or durable goods orders, retail sales, And this would be pretty much all that should move the US dollar Canadian dollar in terms of fundamentals. Now, how to trade this US dollar Canadian dollar? Well, first of all, trading the pair in strong relation with what is happening with the commodity currencies, with the commodity markets. This is a commodity currency, the Canadian dollar, and both US data and Canadian data influence the pair strongly. So a short review is a less liquid, it is a major pair, bigger spread. Bank of Canada is the central bank that meets every Wednesday. Oil inventories, OPEC meetings, anything that is related to oil strongly influences this currency pair. Thank you very much for being here. The next one, we're going to look at the Australian dollar and US dollar. Let's see what's more important for Aussie. Bye bye.